Okay, so Carl, leaving aside all of the potential fundamental drivers, the macro drivers over the next couple of weeks, I'd just like to know technically how we're set up in terms of equities here in Australia. So give us some context as to the Santa Claus rally, if it came to fruition as had been expected, and what that means likely for seasonal thematics playing out in the next few weeks.
Yeah, look, I mean, it's the perfect time of the year to talk about seasonal thematics, isn't it? I mean, to sort of set our compass for 2021 based upon, yes, it's history and it's what's happened in the past. But, again, it's lies, damn lies and statistics, isn't it? So, look, take them with a pinch of salt, but also, there are certain things that happen underlying these themes. So, you've got the end of the year in the US, so there's certain tax loss selling, then there's reallocation of capital, and these are things that happen every year. So I say take seasonality with a pinch of salt, but there are some fundamental drivers behind the seasonal theme. So what typically happens in January? Now, let's look at it more from a global perspective and focusing more on the benchmark S&P 500. So typically January is a down month. It's a down month by about 0.3%. Might not sound like much, but your average sort of month is up by about 0.5% or down by 0.5%. So within that context, it is certainly a down month. Interestingly, February is actually worse than January, and that's usually down about 0.5%. But as a 2-month run, January and February might surprise viewers. January and February are the worst 2 months of the year for US markets, and they tend to be, apart from September, the more volatile. So as I get a message coming through here, so watch that. So we often talk about this concept of sell in May and go away, and that is because the period from March, April, and May is the best 3-month period of the year. People often think, oh no, it's got to be the end of the year. It's got to be December, Santa Claus rally. It's actually not. March, April, May are the 3 best months of the year, and by a long way. So the average return over those 3 months is about 3.5% versus about 2.8% for those last 3 months of the year. And potentially some of that is because of January and February being so bad. So watch out. You sell in May and go away is actually not the most sensible thing to do. Sell now and come back in March, historically, has been the more sensible thing to do. It's often a consequence of generally the good run we have in December. So, just a note of caution there. Just I guess, as I said, setting that compass for what could happen over the next few months.
All right, maybe we'll leave it there. Carl, great to have you on, and we'll chat later in the week, no doubt. Carl Kapelinga there joining us from Think Markets.
Thanks, Nadine. Thanks, David. Catch you later.